All right, good afternoon. This is Carrie Sparks with Pioneer Title, your Arizona title gal. Happy Thursday afternoon. Hard to believe we're almost to Friday. Welcome to our presentation with Brandon Hughes, and he's going to talk about 1031 exchange today, which I'm super excited about. So for everybody out there that is going to want to get a hold of you, I'm going to have you kind of give your contact information in a second, but for all my customers that are out there watching, thank you so much for choosing to work with Pioneer, choosing to work with me. If there's anything at all that I can help you with, something you're working on, that you need a little assistance with, I'm here always. 602-715-5704. Again, Carrie Sparks, your Arizona title gal. Brandon, I'm going to turn it over to you. Can you say a little bit about you, your contact information, then I've got a couple things to ask you, and then we'll get into the slides.
Sure, yeah, let's do it. So hi, everyone. First off, thank you, Carrie, again, for having me on the Carrie Show for a second time. And this is just going to be a quick, brief 30-minute or so webinar, continuation of what we did a few weeks back. So hopefully we have some repeat viewers, but if not, we'll get you caught up. It'll be good. My name is Brandon Hughes. I'm the Arizona Division Manager with Asset Preservation, Inc. And we're a qualified intermediary, which essentially means that we're the entity that facilitates the 1031 exchange. We prepare the paperwork, hold the funds, just facilitate the transaction in general. If you want to reach me, the best way is probably my cell phone. It's 480-392-4952. Additionally, my email is Brandon, BRANDON, @apiexchange.com.
And what's the website to get a hold of that too?
Same as my email. It's just apiexchange.com.
So there's a couple things that you and I were talking about before we went live, and just curious, has there been an increase in the volume of 1031 exchanges over the last few months with COVID-19?
Yeah, so March started to slide down. April was a pretty big dip. I'd say June, we saw a slight uptick. I think people are optimistic, maybe more on the market, more people are willing to do an exchange that they had previously wanted to do in, say, February, but they put it off until now. Hopefully that continues. We'll see what happens.
Is there a particular area of the country that it's a little bit more popular in than others?
I'd say the areas that are least affected by COVID. Arizona, we're maybe a little slower than some of the rest of the country, but I mean, we're doing all right. I think we're probably middle of the road.
How about on the issue of land? Are you seeing land exchanges?
Oh, yeah. So land exchanges are huge right now. We're seeing a lot of people trading land. And I think maybe the caveat with that is you're not going to go out and visit a bunch of pieces of land. You're probably just going to, exchange from one to another. Whereas if you're exchanging homes or multifamily, you're going to probably want to look at it.
There's a couple other questions that I think we'll just wrap it up with at the end. And the questions are typically, what's the future? So we can cover that at the end. And of course, during the course of our presentation, we'll go over when to start talking about doing an exchange and when not to possibly do an exchange. So I will let you take it from there, Brandon.
Yeah, that sounds good. All right. So just a quick outline, just so you guys know what we're going to be doing. So 1031 exchange terminology, this is going to help get you caught up. Sale versus an exchange, we're just going to do an example. We're going to go through someone doing an exchange, someone doing a sale, kind of compare the two and see maybe where there's pros and cons. Partnership issues, so this is where you want to do an exchange, maybe the property's in a partnership. Vacation homes, this is a quick thing today, but if you guys have any questions on it, because I'm sure a lot of you do, especially those up north, we have a pretty good flyer on it, or actually it's a whole pamphlet, and that could help you out. We're going to cover the exchange equation. So this is the best way to complete an exchange, and then some things that come out of it, such as boot. We're also going to go over the delayed exchange again, just briefly, just to revisit it and refresh your memory. And then we're going to do a multi-property exchange and a reverse exchange example. All right, so let's start at the top here, boot. So boot is simply defined as non-like-kind property. And there are two kinds or different types of boot. See the next bullet point here, there's cash boot. So that's all the money you pull out of the transaction and the money you put in your pocket. The other one is further down the list, I think a few from the bottom here. Yeah, that's mortgage boot. This is a reduction in your mortgage liability on the new property. So we call that the replacement property. And it's going to be a reduction compared to the one you sold. So sometimes you'll hear this referred to as debt relief. All right, constructive receipt. Your client may not have physical possession of the money, but they're legally entitled to the proceeds. So this could be where you close a transaction and you leave the money with Pioneer, right? But you don't set up an exchange. So that still becomes taxable to you. So that's something you want to keep in mind. We have people every month who they call in, they want to set up an exchange, but they wait, and really it's just too late. So they're in constructive receipt. You got to set up your exchange before you close escrow, and then later on, Carrie's going to ask, maybe before that when you should start getting your exchange set up. All right, direct deeding. So direct deeding is just the direct transfer of title from the exchanger directly over to the buyer, and then from the seller back to the exchanger. Exchanger and taxpayer. So these are synonymous terms. The IRS likes to call them the taxpayer. Could be you, an investor, client. The exchange agreement. So this is a document that outlines X amount of properties that are being given up, or X amount of properties that are being purchased, and who owes the property, how it's owned, money that might be subject to certain restrictions, that sort of thing. This is something that we, the QI API, would set up. Now we have the exchange period. So this is a maximum of 180 calendar days, but with COVID virus, it was temporarily extended. We talked about that a few weeks ago. At this time, we're waiting on additional guidance from the IRS to see if they'll continue an extension, but for now, the ability to stretch out your exchange is not available. So it's still the same deadline. Speaking of which, we have the exchange period. So, or we have the identification period. So this is 45 calendar days. So this starts as soon as you close, and you must identify your replacements. Like-kind property, you hear that term, but it just means any real estate that you hold for investment or use in a trade or business. So it could be land, sell easement, commercial center, multifamily, all like-kind, you name it. Mortgage boot, we covered that. Qualified intermediary, kind of covered that, but it's the entity that facilitates the exchange. So we prepare the paperwork, hold the funds, etc. Sometimes you'll hear us refer to ourselves as the QI, maybe the accommodator, the facilitator, and these are, again, all synonymous terms. All right, finally here we got relinquished property. It's the one being given up. And replacement property, it's the one being purchased. So all basic terms, but good to know if you're ever in the middle of an exchange, or maybe you have a client who's asking questions about exchange. You can kind of be on top of it. All right, capital gain taxation. So this is a slide from last time, but I've added it just to give a quick refresher on why we would want to defer taxes. As you can see, there are 4 different levels you may be subjected to when you sell appreciated property. So taxes are first assessed on any depreciation recapture. This is at the rate of 25%, pretty high. The remaining economic gain is taxed at the federal level. And taxpayers, they're going to be either paying 15 or 20%. Typically, if you're selling a property, you're probably going to tip in that 20%. The third one we call the net surtax, or the net investment income tax. It's 3.8% tax assessed on higher income earners, and it's only for investment income. This was brought about during the Obamacare era. Then, of course, we finally have state taxes. So it's around 4.5 here in Arizona, but as you can see there, we got the range. The highest would be 13.3 in California. So as we said last time, investors, they can get slammed with a much higher tax bill than what they were expecting. And this has really created the perfect storm for people to choose a 1031 exchange. All right, another quick refresher. So the 1031 exchange, what is it? What are we doing here? Well, it's a written part of the tax code, and it's been a part of the tax code for almost 100 years now. It's not a cheat. It's not some loophole, as some would have you believe. It's really written in there, and it allows taxpayers to defer all the taxes that would otherwise be incurred upon the sale of their relinquished property, specifically investment property or one held for trade or business. So when I explain to people, I typically say, and this is one of my favorite things, it's a tool to make the IRS's tax dollars your equity in a new property. Sale versus exchange. So now we're just going to use an example to compare the potential differences between a sale and an exchange. And don't get too bogged down in the numbers here, because that's what the accountants are for. But this is just going to be used to compare the two. So we have a couple. They're going to sell their property in California for a cool $1 million. And some of you might have already noticed or taken note that we chose to use California in our example because it's going to exaggerate taxes to make my point. But let's continue. So the couple, they originally purchased the property for $400K. And we're going to assume that $300K of that was allocated to the building and $100K was allocated to land. So they appreciated the building over the years, and we're going to assume that they've had it for a long enough time that they've appreciated it entirely, again, to make my point. So our calculated capital gain at this point in time when they're going to sell it is 900K of the $1 million sales price. So the couple's AGI, or adjusted gross income, was 1.4 million for the year, including the sale. So we're going to assume that they're making money aside from the sale of this property. So this couple, they're going to be taxed at 25% on their prior depreciation reductions taken, 25% on the federal capital gains rate, and 3.8% on the net investment income tax. And then of course, 13.3% for the California tax. So the next slide here, we just break it out. Again, don't pay too much attention to the numbers, but as you can see, we're calculating out the 25, 20, 3.8, 13.3 to get the total taxes owed at 348,000, almost 349,000. So reduce that from the sales price, you get your net equity. They're going home after paying tax with 651,000. Now in exchange here, you can see that they're going to be putting forth $1 million into a new property. So Carrie, you there?
Let me unmute. Yeah.
I've got a question for you. So of which of those two amounts, the 651 or the $1 million, would you rather reinvest with?
You're putting me on the spot. I'd rather reinvest with the higher amount and buy more property.
I figured I'd give you an easy question, and I can answer it too. It's pretty simple. Yeah, but definitely you're going to want to go off and acquire a new property with $1 million. And below there, you can see we have a loan to ratio value listed. Don't pay too much attention to that. What we're really just trying to prove here on the slide is that in an exchange, you can almost exponentially help grow your investments and potentially your month-to-month cash flow. Because what are you going to want coming in? You're going to want monthly rent from $1 million property than a $651,000 reinvested property. All right, now we have some partnership issues. So we get a lot of questions on these. Sometimes REIT questions will kind of fit into the same category, but really partnerships can be tricky for people who want to do an exchange. So let's say that we have a partnership, 3 partners. 2 of these want to do an exchange, the third does not. Well, the partnership owns the property that's going to be exchanged. It's like-kind property. So in this instance, it would be difficult to do an exchange because the partnership would be or need to be the one doing the exchange, not the people within the partnership. So as you can see here, I think it's the 3rd bullet point down, the partnership interests, they're specifically excluded from section 1031. So in this case, we wouldn't be able to do an exchange because the partners don't necessarily own the property. They just own a partnership interest. It's the same thing with a REIT. You don't own the property, you own a percentage ownership in the REIT, and the REIT owns the property. So we have a couple things we can do here. We have a drop and swap and a swap and drop. So this involves dropping the property out of the partnership and then doing the exchange. So you got the 3 people, you drop the property out, they become tenants in common. 2 of the people do the swap, 1 person doesn't because it's dropped out of the partnership. Now they have ownership, they have title for tenants in common for those 3 people. Of course, you can do a swap and drop, so that's where you do the exchange, and then right after the exchange, so the partnership's the one doing it, then after the exchange, then it drops back down into the 3 people again. So this would be directly after, so then you would just pay out the one partner who didn't, or after the exchange, who didn't want to be part of it or have ownership of the new land. But a swap and drop and swap, they do have their issues, and these are something that you should be aware of. So there's holding period issues, and if the drop occurs too close to the swap here, the IRS might say that it's not held for investment. So they might come after and say, hey, you didn't, as a taxpayer, intend to hold this for investment, the partnership did, so it's disqualified. Same thing on the other end. So the partnership's done the exchange, and now the people you're dropping it out at the end, and those people, they're not really holding it for investment. Again, the partnership was going to be trading for an investment. So if these happen too closely, there could be an issue. Typically, if the people come to us and they say, hey, we're in a partnership, we want to do a swap and drop and swap, we recommend to have the best chances of your exchange being accepted or working, you want to put as much time as you can between dropping it and swapping it, or vice versa. We won't go too much into this, but there are cases that say it is okay to do a drop and swap. But then, of course, you have the Franchise Tax Board in California. They pretty much disallow every single drop and swap case. So for anyone in California, we typically say not a wise choice. And you guys might have clients, or you yourself, you might be trying to move from an investment property in California right now that's appreciated a bit into Arizona. So we do see this quite a bit here in our beautifully warm state. All right, vacation homes. So again, we have a great handbook, and it goes over this exact topic. So reach out to me with a free electronic copy, and it really helps you out. Oops, go back one. So vacation homes fit into a special category. It's called a safe harbor. It's something the IRS set up to help people do a vacation home exchange correctly where they won't get in trouble. So if you sit within the rules of the safe harbor, you're fine, you're not going to get in trouble. You can do an exchange outside the safe harbor, but you're in rough seas, right? So you might get audited, there might be an issue. But the IRS has said, follow these rules, you're going to be okay. So what are these rules? Vacation homes, it's tricky. So the relinquished property and replacement properties, they have to be owned for at least 24 months. So that's qualifying use, it's 2 years. Within each of these two 12-month periods, this is where people get really stuck. You personally, the taxpayer's personal use cannot exceed 14 days or 10% of the time it is rented. So typically 14 days. And additionally, to kind of show your intent that it is a rental property, you should rent to another person, could be family member. We've seen rent to a father or a son for more than 14 days the rest of the year. And that really does show that your intent is to hold for investment. And if you fit in these rules, you're fine, do a vacation home, but definitely ask for a copy of our handbook. You can use it yourself, distribute to clients. It's very useful. All right, the exchange equation. This is helpful too. So for full tax deferral, the taxpayer's got to meet 2 requirements, just 2 for full tax deferral, okay? 1, reinvest all net exchange proceeds. 2, acquire property with the same or greater debt. And we're going to go through a couple examples to see instances where you might have boot or where you won't, and where you're doing an exchange that will defer all taxes. So our first example here, got a relinquished property. It's sold for $900K. They had remaining $300K debt on it, and they have the closing costs of $60K. So their net equity in the property was $540. Okay, now they're requiring the replacement property through the exchange. This property was a bit more expensive, which is typically what you want to see. We have the debt that's more, so it's equal or greater debt. And we also have net equity that is the same. So they've put all of the exchange proceeds into the new exchange. As you can see, there's 0 boot. So there's no tax. This is a full tax deferral exchange. Oh, it's making me click through again. All right, here we go. This is a different example here we're going to go through. It says office exchange. It could be a home. Don't let the numbers fool you. You could drop a 0 off all those. It's the same thing. So the relinquished property, they sold it for $5 million. Debt was $1.5 million, and closing costs were around $300K. Net equity came out to around 3.2. So they go into their replacement, again, more expensive, so that's good. But then we run into something. Their debt is greater, so that fits the second requirement. But then the first requirement, net equity, all exchange proceeds must be used. In this instance, that's not the case. They didn't use all the exchange proceeds, so they had, if you remember from earlier, cash boot. And in this instance, they're going to have to pay capital gains tax on $670K worth of gain. So that's not their capital gain. It's going to be the percentage of that. But that's the taxable portion. All right, if you guys remember from last time, it's another quick refresher. This is the most basic type of exchange. It's the delayed exchange. It's also probably the most common format, as I said last time. At API, around 90 to 95% of the transactions we do are just a simple delayed exchange. So let's run through this again just real quick. Hopefully you're somewhat familiar with it, but we'll catch you up. All right, the taxpayer, that's you. That's the exchanger, what we call them at API, and then IRS calls them the taxpayer. So during the exchange, through the assignment of a contract and through the use of the exchange agreement that API sets up, the taxpayer will direct deed the replacement property to the buyer, and the buyer will send the funds through escrow directly to their exchange account, the equity portion. Qualified intermediary will sit on the funds. Then once they've replaced or identified their property and are looking to finally replace it and close on it, the qualified intermediary, instructed by the escrow officer, will send the funds to the seller. The seller will direct deed to the taxpayer. So we went over this a bit last time, but it's not a sale and purchase, it's an exchange. And that's really what makes this possible. All right, so now we're going to talk about the multiple property exchange. So getting more boxes on the screen, don't get too nervous. So same thing though, you can see up here, got the taxpayer, we got the qualified intermediary, we got the seller, we just have 3 buyers this time. So this person's relinquishing 3 properties and going into 1. So maybe they have 3 condos, they're not having fun with renters, they're done with that. Excuse me, they're thinking, let's go into a commercial building, something that's going to have 1 renter, it's going to be much easier. So that's possible, you can go from 3 to 1. So in this case, the taxpayer is going to deed the properties to all 3 buyers. The funds are all going to go to the qualified intermediary. And then once the taxpayer has identified the replacement property, the single one, they're going to, the QI is going to direct the funds to the seller, and the seller will direct deed to the taxpayer. So again, another exchange. However, these can be tricky. And I'll tell you why here. So as soon as, let's say, buyer number 1 and the taxpayer close on that first sale, that triggers the start of the 180 days. You will then have to sell to buyers 2 and 3 within that 180 days and still close with the new seller within that 180 days. So you're somewhat restricted once you get started. It doesn't keep adding 180 days. It's just the single 180 days that triggers as soon as that first property closes escrow.
Hey, Brandon, what happens if you exceed that time period?
So if you exceed the 180 days, your exchanges fail and the funds become taxable. And the IRS would actually consider it taxable at the time of the sale, retroactively. Again, we have another multi-property exchange, but in this case, they're going from 1 property to 3. So maybe they had a opposite, giant commercial building, no longer need it, it's no longer in use. You know, we're just going to diversify into a few small pieces of land we think are going to appreciate. So in this case, exactly the same thing, direct deeded to the buyer, same delayed exchange, funds go to the QI, and then they close on 3 different properties, 3 different replacement properties. Again, this is difficult potentially because the 180 days starts as soon as they close escrow with the first buyer. And then they need to identify all 3 of those properties within that first 45-day period. All right, parking arrangements. So we're not going to go through this too much. We're just going to touch on it, and I'll tell you why. So parking arrangements can be complicated. They are useful. It's a great tool to have in your belt, but we could do an entire class on this. They are pretty complicated. So today what I'm going to do is just touch on the reverse exchange. We're just going to do a quick example, and we're going to show you how this works. I will go back though. So it is important to note that along with the reverse exchange, there's something called an improvement exchange. It's where you can build something, but again, it has to be in that 180-day period. Sometimes if you're just doing or pouring the foundation on a giant commercial property, that might alone be enough to meet your exchange proceeds that you had from your relinquished property. But it's definitely something we can go over in the future. Reverse improvement, this is where you improve the property before you relinquish a property. You can also do that. But today it's just going to be the reverse. So again, don't get too caught up on this. It's just for visual representation. If you are interested in something like this, give us a call. We'll walk you through it. But in this, we have the same thing going on. We have the exchanger, just like the delayed. We have the buyer. We have the seller. Then at the bottom here, instead of QI, we have the EAT. So what is the EAT? It's the Exchange Accommodation Title Holder. Essentially, it's an LLC that the QI sets up. So this is why the reverse exchange is typically a good bit more expensive than a classic delayed, is because there's more that goes on here. So delayed or reverse exchange, it's where you find a property and you're going to close on it before you relinquish a property. So it's just a delayed exchange in reverse. So here we go. The exchanger, taxpayer, they're going to give money to the LLC. They're going to put money into it to help purchase this property. Because think about it. They haven't relinquished the property, so they don't have funds at this point. And as a result, the EAT, the LLC, gives a note back to the exchanger. Then the exchanger identifies a property that they'd like to purchase with their LLC. The QI facilitates this, and we go ahead and have the LLC purchase the replacement property. The replacement property is deeded to the LLC. but we're not in the business. API is in the business of managing LLCs and managing properties, so we lease it out so that you can either develop it, you can collect rent from it, that sort of thing. Then at this point, they've decided they're going to relinquish the property that they had formally identified with us. They'll direct deed it to a buyer, and the funds will go to the EAT or the LLC. So at this point, we typically give the cash back, the exchange proceeds from the relinquished property, and then we'd also deed the acquired replacement property as well. But typically how we do this is we just transfer the LLC into the exchanger's name. So as you can see, pretty complicated, a lot of arrows. Just give us a call, we'll walk you through it. It's definitely a good tool to have. And with that, hopefully we didn't drown you with too much information. Exchanges are a useful tool, and even though they can be a bit complicated, you really have API on your side. Feel free to send me an email, give me a call, and we'll talk and see what options we can create out of your specific situation. Make sure to always do QI due diligence. That's determining who's going to hold your funds. There's a lot of QIs out there. We're not a federally regulated industry. It's good to have a QI who, one, has experience. We've been here 30 years. We've been doing this a long time. Done over 200,000 exchanges, and also can back it with security. So we're owned by a private company, traded on the New York Stock Exchange. They allow us to offer a letter of assurance over it. Never had to use it, but it's a good tool to have. Additionally, we hold 600 million bond, I believe, that'll back your exchange if there ever were an issue. So, Carrie, what do you think?
All right. To me, complicated. I'm gonna stick to selling title insurance. You go ahead and do this. But I had a couple questions I'd written down here. What do you think the future is of 1031 exchange? Where do you think this is going to go?
Ooh, that's a good question. So there is talk. I think Biden's plan, if he were to be elected, he has a plan to potentially alter 1031 exchanges, or there's a whole tax deal. But of course, with everything else, it's one who's going to be president, and then of course after there's who's president at that point, you have the House and the Senate. Really, major tax reform doesn't happen unless all three branches of government are under the same people ruling. So we're not too worried about this going away. It's been in the tax code for 100 years, in some way or another. So I think this is something that's going to stick around. I think we have a lot of good people educating, making sure that people in our government know that this is a valuable tool for just not just a high net worth investors, but for just kind of the common person. It's a useful tool.
From the title perspective, we always appreciate to find out that something's happening on an exchange as soon as possible. What are your thoughts on that?
Oh yeah, definitely. Be letting your real estate agent know. Definitely the title groups know as soon as possible when they find out, and it's a surprise to them last minute. I know I've seen a bit of scrambling, but I typically would say for a delayed exchange, 2 weeks or so before you close escrow, you can let us know. If you'd like to let us know 2 months in advance, we'd love that as well. It gives us time to set it up, gives you time to go over your options, and it gives your title team time to help sort all the paperwork out and work with us.
If somebody's considering it right now, though, and closing in the next few days, although we, all parties to the transaction would like to know as far in advance as possible, but, let's just say someone's closing tomorrow, can they still call you? I know that makes you really happy.
Well, I mean, I'm already red. I'm probably turning more red. I don't love to advertise it, but we have in some cases spun a exchange agreement around in as little as an hour. So someone came in, they talked to their escrow officer right as they were about to close. And they were saying, hey, we want to do an exchange. Escrow officer kind of rolled their eyes, but gave us a call. We said, okay, go get coffee on us. Maybe not saying we're going to get coffee for you, so don't be waiting till the last minute. Go get coffee. An hour later, we had an exchange agreement in their hand to sign.
Are there any differences between, doing a residential transaction versus a commercial transaction?
Really, no big difference. We charge
the residence condo or an apartment complex. It's really handled the same, isn't it?
We really handle it the same way. We give the same amount of care to everyone. The process is nearly identical. It's It's not much different. And of course, you have people who are exchanging all the time from one like-kind property, such as commercial to a residential. So you see the jump all the time there.
It's my understanding that a few years back they changed the definition of like kind, and I mean I don't want to go into it here, but it used to have a broader scope as to what like kind was, but I believe it's been narrowed down. And for those people who haven't gotten that definition like in the last couple of years, what do you say to that? Call you right away.
Yes, definitely give us a call. We'll tell you what works, what doesn't. It's really real estate at this point. It used to be you could do a bunch of different things. I think it was 2018 where it was really narrowed down. Before, I've talked to some of our colleagues, they've done exchanges on coin collection, stuff like that.
Airplanes and all kinds of different things.
That's going a little ways back now. But
so I bring it up because I did a class a week ago and they were talking about the change in that. So it's a big deal. If you haven't had one of these classes in a while, it's really important because the definition has changed. But just kind of in closing, you touched on it for a second. You guys have some marketing materials for realtors, don't you?
We do. We send these out a lot. So we have something like over 170 different articles that we can give to you to give to clients. You can customize them yourself. Either contact us or go to our website. It's there at the bottom, apiexchange.com. And you can definitely use those, and it kind of gives you a look that you know what you're doing, and it's helpful. You can always give us a call and we can relay information that way too. And then we have pamphlets, all sorts of stuff. A lot of it's electronic these days. But
I know, it's kind of the way of the future, just like us doing this right now. So Brandon, thanks for coming on my show. I did name it kind of in fun that I call it Headlines. And so you would be officially my headliner today.
Oh man, that's honor for the
kind of heavy, right? But thank you for doing this. I know you're busy, and you were mentioning how many deals that you had opened up already this week. So I know that this is a hot topic for you and for the industry. So with that being said, everyone have a great rest of your day. All these videos are hosted on my YouTube channel, so you can go back and reference them again. But I'm Carrie Sparks with Pioneer Title, your Arizona title gal. And just give me a call. I want to help solve problems right now. Really, my big buzz statement is your value is determined by the size of the problems you solve for your customers, and I'm out to really help people solve their problems. So give me a call if you don't have a relationship with anyone at Pioneer Title at 602-715-5704. Again, thanks, Brandon, and have a great day, everyone.
Thanks, everyone.